as we get into the Southeast, which is majority of our business, which is ground up construction for single family and small multi, for a single family house, you're probably in that $250,000 to $300,000 range on average. These are the areas. This isn't by intention, by design. We want to be in areas which are below the median house price point for the U.S. and those areas specifically. Median house price point below in the U.S. I think it was at 408 and it just dropped to around 400,000 recently. But anyways, we try to be well below that because that means we're going to have the largest pool of both tenants and homeowners potentially when you sell the property. And the average holding time for most of our investors is 3 to 5 years. They buy a property, they hold it, they rent it out, cash flow great. There's really usually no maintenance or very little because it's new construction. You have builder warranties. They grow, they build appreciation through just normal appreciation and or build equity through appreciation and the tenant paying the loan down. And they likely sell. This is dependent, right? Sell within that 3 to 5 year period and 1031 exchange to expand their portfolio. But yeah, typical price points in that $250,000 to $300,000 range for single family in most of these areas.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Darrin. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Zach Lemaster. Zach is the founder and CEO of Rent to Retirement, the nation's leading turnkey investment company. And in just a minute, we're going to talk with Zach Lemaster about Rent to Retirement. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Zach Lemaster. Welcome to CREPN Radio.
Darrin, thank you so much for having me. I'm very excited to be here.
I'm looking forward to our conversation, but before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Certainly. So I have a background, nothing to do with real estate. And I think as many of us find ourselves in real estate, we came from a different career path. So as we were talking before the show, I mean, my wife and I are optometrists by education. We went to school in your neck of the woods out in Oregon. So I joined the Air Force. I was on scholarship, on the HPSP scholarship. I was a captain in the Air Force for 7 years, practicing optometry. That's where I started investing in real estate and got the bug. First house I bought, duplex, lived in half, rented out the other half, used a VA loan, fell in love with the real estate, very tangible, easy asset. And I could kind of conceptually see how you can build wealth over time. And so from that point in time, which is about 15 years ago, I invested in real estate every single year. And I haven't taken a year off over the past 15 years, regardless of where market cycle is, interest rates, whatever. But there was a pivotal moment, Darrin, that really changed the trajectory of our investing path. And I say our, my wife and I, but also allowed us to build a successful business venture. And this was the simple fact that we started to learn how to invest strategically across the country in markets that offer the best opportunity, not just being solely focused on investing in our backyard because that's what we, felt comfortable with. And that wasn't easy to start, but we did, we were determined to first identify the best markets throughout the country and then build our teams and systems in those areas to expand our portfolio. And that changed the trajectory of our lives, really, because it allowed us to expedite our success, being very strategic investors on accessing the best opportunity. And so really what that allowed us to do over the course of probably 5 to 6 years is retire ourselves. And my wife's also an optometrist. And we moved out to Colorado after I left the Air Force. But We were in private practice. It allowed us to ultimately replace our active income, as doctors, through real estate. That didn't happen overnight, but it did happen over many years of intentionally investing strategically in the best markets. And ultimately, that led to a lot of our friends, family, and colleagues saying, "Hey, we see the success you're having in rental real estate. Like, can you help us get started? Can you give us tools and resources? Can we invest with you? Can we give you money, et cetera?" Just people needed some resources to help them start investing and following the same path that we did. And so that was a birthplace of Rent to Retirement, which is, as you mentioned, the nation's leading turnkey investment company that we founded many years ago, where we essentially help people build their own investment portfolios across the country where we take care of everything. These are turnkey properties that are newly built, leased, and managed by our team in one of these markets, so someone has access to easily buy these properties without buying themselves another job as a landlord. Fast forward to where we're at today. We work across 12 to 13 different markets. Last year we did just under 1,000 doors. We mainly focus single family and multifamily, and we love helping investors grow and scale their investment portfolio to be strategic investors to achieve their financial goals. So that's about as quick of a summary as I can give you.
No, that's great. I appreciate you running through it and your affinity for it and your success and your ability to step away from your W-2 and now you're also helping others. That's kind of the fun story of real estate there. So that's good. The rent to retirement sounds exciting. I mean, I think everybody has got the sense of like eventually someday I don't want to have to work anymore. Um, can you explain just on kind of a timeline what your expectations would be for someone that's looking at getting into rentals and essentially creating a retirement, um, money to where they could be either um, free from having to go to work or have a secure retirement.
Certainly. I mean, this is a very individual question, right? Because everyone
Mhm.
is in a different scenario. They have different goals, timelines, resources. Real estate is a very attractive asset class to probably everyone listening because it can offer different things for different people. Some people are looking to invest in real estate just for a diversification standpoint, to not be so heavily in, stocks and bonds and what have you. Some people are wanting to be in real estate for more of a role of what you just mentioned, which is being a full-time investor and actually buying your time back and creating a early retirement scenario. Some people not, right? Some people just like real estate and they want a safe place to put money. Some people are very bullish about the tax advantage of the real estate because they are better than any other, investment available. Just like ourselves, a lot of what we buy right now is commercial retail centers as well as, single family and small multifamily to run accelerated depreciation where we're able to, wipe out our active income from all sources every single year. That could be a goal for some people. So it really is independent depending on what the person is looking to do. But I'll just use kind of a general example. For someone that is looking to create like a full retirement picture, whether this is solely through real estate or in addition to what they are doing with their other retirement funds, the most common number we hear is $10,000 a month of passive income. And we know in rental real estate, the beautiful thing is that because of depreciation and expense write-offs and mortgage interest and all the things, that $10,000 a month is probably equivalent, depending on where you live, of whatever $16,000 to $19,000 a month of earned income, depending on your tax bracket and location. But $10,000 a month take home would allow someone to maybe retire a spouse, cut back at their job, and so it really depends on what the person wants to achieve, what the resources are, and what their timeline is. And our goal is to build out an investment strategy and plan with the investor, but then also show them and provide resources for them to expedite their goals. So you can reverse engineer it if you had a property that cash flowed $500 net at the end of the day. You would need 20 properties to reach that number. Well, if that property was $300,000, say a new construction single family in Florida, Alabama, Texas, Carolina, whatever, then you can kind of reverse engineer. I need X amount of dollars. I need $60,000 to put down to buy that one property, and now I need, 1.2 million to buy 20 of those. Well, that's the reverse engineer math at a high scale. But what we try to do with investors is work with them to expedite those. What other resources can you take advantage of? What type of creative financing? We were talking before the show, Darrin, where we have some creative financing options where Investors can buy properties with as little as 5% down with true investor loans. This isn't talking about living in the property, FHA. You can buy, single family with as little as 5% down. We also offer options where we will actually cover the 5% for people in on select inventory where they could be into something for little to no money down. Because saving up their capital, I mean, capital is the most limiting factor, right? That is always the slowest path to take. But as you start to grow your real estate portfolio, it's cool where you get to the point where your properties are buying properties and you're going through 1031 exchanges and trading up without injecting more capital. And so you do have this hockey stick growth over time, as well as taking advantages of the taxes, like through cost segregation, accelerated depreciation, things like that. So I could go on and on and on, but I better stop there just to paint a picture of an idea of like, that's kind of the average investor, what they're looking to do in, say, the next 5 to 10 years. And we hope to help them expedite their goals.
Right. No, I love the, you know, laying it out and as far as what the range of possibilities are and, how you can achieve that. So for the markets that you're investing in, you said, was it 13 markets you're currently in?
Yeah, and we're actually about to open up quite a bit more. I can expand on the business decision there as well. But yeah, we mainly focus in two geographic areas. This would be Midwest areas like Ohio, Missouri, Indiana, and then the Southeast is where we're more active. And this is especially on the this is all new construction because we do have some homes we rehab and lease and manage for investors as well. And those are lower price points, maybe like on the low end, 120 to 150,000. So very accessible. Someone could get into one of those with $30,000 down. But we do have, if they're putting 20% down and not using one of those creative options. But the majority of the markets that we focus on are growth markets in the Southeast. And these are areas throughout the entire state of Alabama, Florida, Carolinas, Texas, Tennessee, Arkansas. These would be some of the markets where we're doing ground up construction for single family and small multi, where I just think that, while the houses are a little bit more expensive than the Midwest, average price point maybe 250 to 300,000. These are more growth markets, right? Where they're still cash flowing today, depending on the leverage you're using. But with typical Fannie Mae, Freddie Mac loans, you can still get a 8 to 10% cash on cash return. But you're likely to see stronger appreciation both in rents and home prices over time to allow you to expedite your success. And so we like being in those growth markets as well.
And when you say growth, is it jobs and population? I would assume they go hand in hand.
They certainly
Uh,
do. They
okay.
go hand in hand. We're also looking at areas that have an undersupply of housing. We have a deficit of 7.2 million homes in the US. So this is the worst it's ever been. It's not getting any better. Construction is slow, which makes our lives difficult. But there's actually an influx now we're seeing a positive influx post-COVID of people into the United States right now at kind of unprecedented rates. Families are growing and families are expanding. And there's a big population shift down to the Southeast. So there is an extreme discrepancy between supply and demand in a lot of these growing areas. Those are the areas we want to be in, right? Because from a build to rent perspective, those are the areas where we know we're going to have a large demand for housing from a large demographic of tenants to keep the houses rented and to have rent growth over time.
So in your build to rent model, are you acquiring like acreage and developing and putting down in like a community of rentals, or are you buying individual lots and doing infill?
Most of it's infill. We
Okay.
do very little community development. Now we do some stuff on the retail side, and that we really have two business models here. Actually, three, to not get too deep into the woods. But the first model that we do is like we're the builder. We actually go in and acquire the land, develop the land, like all the way ground up. That's a big lift, right? With our internal team, we have much more demand than we can fulfill. The second thing we do is we buy land and hire builders to build homes for us. And the third model is we actually partner with large national and regional builders to make their inventory accessible to our investors as well. So it really just depends. The goal is to have a diversity of investment options across the country to each investor, depending on what their goals are, so they can pick and choose what makes the most sense to them. And our biggest benefit to like the biggest value add we bring to investors is the ability to buy single family and small multifamily build to rent properties at discounted rates and have buyer incentives that the institutional buyers get that the individual investor does not have access to if they're investing on their own, because it's a volume play. So like, for example, we were the biggest buyer of DR Horton Homes last year in Florida, which is the nation's largest builder. And so we were able to go and negotiate wholesale pricing from DR Horton for all their inventory and make those accessible to our investors. So they could buy one of our properties that we're developing or building. They could also access DR Horton inventory at a discount below what, say, they could just go off the street and buy from them. And this is sometimes $20,000 to $40,000 below market value. And so we are able to negotiate that for the individual investor because we're, collectively a whole, doing large volume with them. And that would be true of like LGI Homes and Toll Brothers too. So this is very interesting for people. And this is a newer version of our business, but like someone could literally go onto the LGI Homes website, their nationwide builder, pick any home there and facilitate the transaction through us and get at least a 5% discount on the home, which they would not have access to just if calling their the retail office, right? For LGI, they're not going to negotiate, $30,000 off the house, but they do have that access. Now, there's select markets within from LGI Homes that we know that will perform well from a rental perspective, and those are the ones that we publicly offer to people. But without being too long-winded, those are just kind of the different business models that we have available to our investors.
Yeah, it's fascinating. It's awesome, the relationship you've got and the ability to offer a discount up front. And I'm assuming that helps with the numbers with your financing. I mean, if the market price for a home is X and you're getting it 5% below, does that not help with your lending? As far as are you able to recognize that as part of your capital stack for your down payment, or?
Well, it depends on what type of financing you're using, and we do make different options available. So, like if you're just using Fannie Mae, Freddie Mac lending, your conventional financing, they're going to go based on,
The net, whatever you're.
yeah, the appraisal or the
Yeah.
purchase price. So it's not like you can roll that as equity.
Okay.
On a refi, if you bought it and refinanced it, you would have some immediate equity to potentially position yourself to do a cash out refinance. And that's a common scenario with investors where they come in with, whatever, 5 to 6, 7% immediate equity in a house, which could be, yeah, again, 30, 40, sometimes $50,000, depending on the home price, where it covers a large portion of their down payment, but they can't use that when they're first buying the house. But then in a year or two, if the home continues to appreciate and they continue to pay the loan down, or the tenant does, like, you could realistically, we call this burring new construction, where you could do a cash out refinance and pull a large portion of your money or all of it back out within, it is realistic within 2 to 3 years, assuming that you are, buying in a growth market. However, I want to point out too, Darrin, that, we offer options and creative things for investors where they don't have to take that 5% as equity. Sometimes people don't want to do that. One thing we can do is we can actually provide that back to them as a down payment credit that comes through the managerial team post closing. And so that is a way to get, part of your down payment back out. So if you put 20% down on a, $400,000 single family house, cash flowing great, you could get 5% of that back, which would be, whatever is that, if I'm doing my math correctly, 20K, I guess, back on that down payment back immediately. That's actually 25% of their down payment amount back immediately at closing. So that will increase your ROI, and that will reduce the ultimate amount of money you're into the deal in. So you can take the equity portion up front and get it below property or a below market value price to have immediate equity. You can get a down payment credit of that 5%. We also have options where, like, hey, we'll buy your rate down if that's something you want to do. If you just want to maximize cash flow and hold a 30-year fixed loan, we can buy your rates down into the 4s and 5s on a 30-year fixed loan using that 5% instead, to allow you to cash flow better. And we also have unique options where, like, hey, we have a local credit union that will will literally do a 5% down payment on an investment property. Actually, they'll do up to 5. You still have to qualify, with DTI requirements and credit requirements. You need over 700 credit. You need, over 45% or under 45% DTI. But if you can qualify for that with a 5% down payment and take the 5% down payment credit, you can essentially have a brand new construction rental property that's appreciating over time. You get your tax benefits, with little to no money down and pay a few closing costs. And I know I'm kind of going on different tangents here, but I just want to showcase the different creative ways we can help people like expand your portfolio. If you're someone that's trying to take accelerated depreciation on properties and that's your goal, well, maybe it makes sense for you to, instead of using your 20% or 25% down on one property, stretch that to multiple properties to have more depreciation, and actually own more assets that are all appreciating more. So just a few different creative ways we work with people.
No, that's good. So the as far as the operations of the rental, you find you have the markets, you have management, and the different trades you need as far as landscape, handyman, that kind of stuff in place, or
Yeah,
how's that
management is
run?
full service, and we do
Yeah.
not do property management at this point in-house. We did at one point in time when we were a much smaller organization with one or two markets, and as we've expanded, we've decided that it makes sense to vet and partner with local property management teams in each one of these areas, and make sure that they're following kind of a systematic approach that we've seen a kind of a proven track record with them to offer management to the teams. And these are full service management, so they handle everything from repairs, leasing, accounting, and distributions. They have, legal sides if you need to go through evictions potentially or whatever. So it's full service management in each one of these areas that you don't have to use if you don't want to. But these are vetted teams that we've personally vetted and worked with in each one of these areas. So when you talk about a turnkey property, this is something where it's simply you buy it and let the manager do their job, where you reap the benefits of the investment property and focus on the big picture, right? Which is spending time with your family, focusing on growing your business over time, not doing the day-to-day management, especially if that's from a distance. That becomes extremely difficult. But we also have short-term rentals and midterm rentals as well. That's something that may be interesting to people in specific locations if they, are interested in a short-term rental. Especially if, on the tax side, if you can't qualify as RE Pro, there's a short-term loophole where, hey, you could participate in management and still take that accelerated depreciation. That's something we work with people on. But we do have short-term rental, midterm rental, and long-term rental options with management teams in place in each one of these areas.
So just on averages in the markets that you're in, what's an average purchase price you're seeing as far as a single family home in new
Midwest,
construction?
which is it's lower price markets, average price would be 150K probably.
Wow.
This is blue collar, type of working, and these are typically not new construction. We do have some new construction in the Midwest, some duplexes, so that would be 2 units in that 250 range. As we get into the Southeast, which is majority of our business, which is ground up construction for single family and small multi, for a single family house, you're probably in that 250 to $300,000 range on average. These are the areas, this isn't by intention, by design. We want to be in areas which are below the median house price point for the US and those areas specifically. Median house price point below in the US, I think it was at 408 and it just dropped to around 400,000 recently. But anyways, we try to be well below that because that means we're going to have the largest pool of both tenants and homeowners potentially when you sell the property. And the average holding time for most of our investors is 3 to 5 years. They buy a property, they hold it, they rent it out, cash flow great. There's really usually no maintenance or very little because it's new construction. You have builder warranties. They grow, they build appreciation through just normal appreciation and or build equity through appreciation and the tenant paying the loan down. And they likely sell. This is dependent, right? Sell within that 3 to 5 year period and 1031 exchange to expand their portfolio. Um, but yeah, typical price points in that 250 to $300,000 range for single family in most of these areas.
And with 20% down, what kind of cash flow are the investors seeing?
Cash on cash return, we're averaging, if you're just using a normal Fannie Mae, Freddie Mac loan product right now, you're probably around a 6% cash on cash return, so that's a few $100 net a month per month, usually between $300 to $500, depending on the home net per property. Of course, there's ways to increase both the ROI and the cash flow on those like we talked about, with either reducing the price on the house, taking that down payment credit back, which is immediate money back in your pocket, or buying the rate down. If we can buy the rate down for you, which we're happy to do, into the 4 or 5% range, that's going to dramatically increase your cash flow, of course, beyond that.
Yeah. No, and new construction, having had both, you know, older that needs rehab, as opposed to brand new. I mean, there's a marked difference from, the capital improvements and just the maintenance on those. So the new that's a pretty good strategy. I would think that people would appreciate that, and especially when if you're only holding it for 3 to 5 years, you're basically out before any paint jobs or anything else would be needed. So
New
that's
construction is predictable,
yeah.
and it's really low low headaches, right? In the right market, because these are not, we don't do low income housing. We don't do Section 8 rentals for these. These are like A and B class areas that attract quality tenants. Same thing with everyone wants new, right? So you have generally better quality tenants that are staying in the properties longer, reducing vacancy. They take care of the property. You have high demand, and they're happy to renew their leases, especially with rental increases. Like our average rental increase per year is 6%, in the Southeast. That's higher than the national average. But when you're in new construction and growing areas where the market rents are normally increasing, you can justify that, and tenants are happy to pay that because they know that that's the market. But yeah, I mean, if you can increase rents year after year at 5 to 6%, that makes a huge difference. And I always like to point that out, because when you're underwriting a property, you're looking at a pro forma, you're looking at year one analysis, right? But you really need to look at, where is this property in 3, 4, 5, 6 years later, after you get that compounding growth, and rental increases over time. You may start with a 5 or 6% cash on cash today, but likely that's not going to be the case. 3 to 5 years later, that's going to be dramatically increased in the right area.
Well, and having professional management in place, I mean, I've managed my own stuff, and I'm so over that. I mean, the having a professional manager that's up to speed on all the laws and has all the ability to communicate and enforce the rules with the tenant. It's just a way better setup to have a professional in there rather than, I remember, thinking about, I don't want to give away, 5 or 10% of the rent. I mean, that's what I worked for. But
We've all
it's,
been there,
yeah,
and
it's,
it's to grow your business and to allow you for real estate to operate the way it should. Like, you hire the professionals in place to do those things, because they're likely going to do a better job than you, first and foremost. Um, but also it allows you to focus on the things that are more time intensive. Like, I always look at it, time value of money, and most investors, their time is worth significantly more than that 5 to 10% of dealing with tenants, right? So you outsource those things.
no, it's good. And as far as the overall strategy, you mentioned that you guys are also into some retail and multi. I mean, is that available to your investors as well, or is that something you guys do personally?
That's a lot of what we do personally. And I will say, so we do have larger multifamily, commercial, retail, and industrial things that we will partner with investors on, um, from time to time, but that's typically not a starting type of deal. The majority of our investors are either brand new investors looking to get started. Maybe their local market is too expensive for them, or it doesn't offer great returns, or an aspiring investor that's looking to grow and scale their portfolio. They want to diversify. Maybe they're a high paid professional that just wants to own real estate and have the financial benefits, but like do it in a passive way. But we have some investors that are looking to take their investing to the next level and participate in larger type of deals, which we do have available. They're just not publicly available. And these are typically after we build good relationships with people, because this isn't like, there's partnerships involved with that. And so some of our investors, after we have a kind of a good dating period per se on doing business together on the single family, small multi, if they have the resources and we have good relationship and their goals are to scale, then we will focus on some larger things like that as well, where we may bring them in potentially as an LP or GP on some of those, or even just a private lender. But yeah, I mean, we do scale into some of those asset classes as well.
And are the single family homes, are those all one investor, one property, or do you have any kind of fund opportunities, or you mentioned the partnerships on the other stuff, but in
Yeah,
the front
we
end?
don't. Yeah, we don't have like a large fund,
Okay.
or a syndication. It's usually when we structure a commercial deal, it's with a smaller group of investors. That just hasn't been a necessity of ours or a big focus. I really like the idea of helping people build their individual portfolios. And I do think that that is like the best way to invest to truly get all the benefits of rental real estate. You could put money into a fund, and many people do, into a syndication. I think a lot of people arbitrarily put money mistakenly into funds or syndications without fully vetting the opportunity or the provider or understanding the risk. Because the reality of the risk is you could lose all your money, right? Like you literally could lose all of your money with no control. That's very unlikely to happen. I know we want to, maybe segue a little bit into insurance and risk evaluation, but like with a physical property, you can insure it. You are 100% the owner and in control of it. Plus, you get to use leverage to scale your portfolio. The challenge with owning physical real estate is it's less passive typically because you got to deal with things. You got to deal with the lenders and tenants, even property managers. You have to manage your property managers, but there is no such thing as true fully passive income because you need to be managing your money. But I think the turnkey investing, what we offer to our investors, is more on the passive end of the spectrum, but still allowing them to physically own rental real estate, to use leverage and all these other things and the tax benefits to be strategic investors. So that was a really long-winded answer to say, we help people build their individual portfolios with actual property ownership strategically. And then as they scale or want to scale, there's like, some limited partnership opportunities with us on larger deals. And that's usually a smaller group of investors that we have a relationship with.
No, that makes sense. Hey, Zach, if we could, I'd like to shift gears here for a second. As I mentioned, by day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk, and that's not an option. We look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, the Fed, interest rates, demand, and identify what you consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And so, if you're willing, I'd like to ask you, Zach Lemaster, what is the biggest risk?
Oh man, we're gonna get deep here for a sec, Darren. I'm gonna get on my soapbox, but and this is investing in general. I truly feel this isn't this cliche answer. I truly feel that the biggest risk is doing nothing with your money and not paying attention to it. Because if you want to live the same life you're living now later in life, then that's what you can do, right? And one event could wipe you out. One event, a health event, a loss in your job, a change in the market could completely wipe you out. You start over. So I just want to say that first and foremost, the biggest risk you can do is nothing. But when you're investing, I think there's so many different ways to evaluate risk. I actually think leverage de-risks your investing. I like the idea of having adequate property insurance in place. We have portfolio policies and umbrella policies on all of our properties. We also de-risk by having the right entity structure in place on our portfolio and separating that out from each other and personal assets. We have whole life insurance policies set up. We invest through retirement vehicles, which are protected accounts. We also invest through trusts, as well as having LCs. Those are all like portfolio structure that I think can de-risk situations. Having the right insurance policy in place, I think, is certainly important. I mean, there's so many different ways to answer this, right? Doing nothing is the biggest risk. And then I think secondary to that, investing arbitrarily without knowing what you're investing in, investing out without fully understanding something or having a plan and strategy, that is probably the next biggest risk that I see in investing. Real estate's a beautiful thing because you can really de-risk it quite a bit. First and foremost, you're investing in a physical asset. You're investing in, and that's why we like residential real estate, because it's human necessity housing. That's never going to go away. People always need a place to live. And especially if you're in that kind of workforce housing location, like those are areas where you will always have demand. And then you properly insure the property, you protect your assets with the right entity structures, you have the right insurance brokers and professionals providing guidance that actually understand your goals. I think that is the biggest way to de-risk. So I probably went on too many tangents there, Darrin. So let me let me stop there.
No, it's all good. I mean, I like the do nothing is, I mean, that is the risk, right there. And then understanding what you're doing and trying to de-risk it as much as you can. That's pretty well said. Hey, Zach, where can listeners go if they'd like to learn more or connect with you?
I always want to send people to our website because we have a great podcast that we put out about all things real estate. We have a great YouTube channel as well, and social media channels. I mean, we put out a lot of really good market data and resources. If you're just an investor that's looking to learn about investing out of state in different areas, growing your portfolio, different creative financing options like we talked about previously, all things tax. I mean, we put out a lot of resources, but our website is renttoretirement.com. That's retirement.com. If you're listening to this on the go, you want to get on our email list, you can text REI to 33777. Again, that's REI to 33777. We'd be happy to connect with you. We don't charge investors anything. We make our money through building and selling houses, right? So that's what we do. But our goal is to add value to every single person that we talk to, and help you build a strategy and a goal. And if you think turnkey investing and investing out of state in some of these growth markets is interesting to you, or what different financing or tax options we talked about, then please reach out and be happy to learn about you and your goals.
Awesome. Well, Zach Lemaster, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and I look forward to doing it again soon.
Thanks so much for having me, Darrin.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.